Today's market call is presented by Fidelity Investments and their all-new advanced trading platform, Fidelity Trader Plus. With Fidelity Trader Plus, you can customize your preferred tools and charts and tap into crucial data across all your devices. So I can save an order on my desktop at home, get a mobile alert here at the studio, and complete the trade in the Fidelity app without starting over. Try it for yourself at fidelity.com/Trader Plus. For 27th, 11 a.m. on the East Coast, guy Adami, Dan, Nathan, soon to be joined by the great Carter Braxton Worth. For you fans of Miley Cyrus, it's a party in the USA, people, in terms of the stock market. How are you, Dan?
It is a party. We're partying here in the USA, but we're partying in other parts of the country and the world, for that matter, actually, too. You were just talking about Japan before we came on here, so it's just a lot going on here. Guy, we got to talk about the China framework. Do you think it's too soon to call it a deal? Possibly, right? Carter Braxton Worth, upward charting. He's got a lot of data on the mega cap tech stocks that are all reporting this week. So we'll talk a bit about that. And maybe we'll get to the gold. We'll get to some of these other things that are acting contrary to what is partying. That would be U.S. stocks.
In the USA, yes. I think we should. Well, what's amazing is, we've seen headlines like this before in terms of frameworks for a deal, and I think one happened in June, if I'm not mistaken. But anyway, the market rallies on these. And again, we heard from Treasury Secretary Bessent over the weekend that basically said there's a framework for a deal. Obviously, President Trump and President Xi, I believe, are meeting on Thursday of this week. So we'll see how it shakes out, but that's enough for the market to sort of, again, build upon the gains that we've been seeing over the last couple of weeks. And the VIX, which I thought was a story a week and a half or 2 weeks ago, is right back down below 16, which, quite frankly, is a remarkable turn of events.
All right, let's talk about the framework for a second here, Guy, because I think this is important. Wall Street Journal this morning, Spencer Jacob, he said, curb your China deal enthusiasm. And I just want to rip through this. Amanda can kind of pull this up here. The very successful framework, according to Bessent, and preliminary consensus, in the words of China's Vice Commerce Minister. That's because we had S&P jump 3.3% in May following productive weekend talks in Geneva. You remember that one between
That was in May, so I was off by a month, but yeah.
And then rose by 0.5% in September after a meeting in Madrid. Other stock rallies include a 1.7% rise in late April. So a lot of stuff going on here. We've highlighted this going back to March of 2018 when we first slapped some tariffs on, this is in the first Trump administration, on China. We didn't have a framework until January of 2020. So there was a big kick the can down the road. We left some some of those preliminary sort of tariffs on China until we had that sort of deal. So what's going on here? We've been throwing around these 150% reciprocal sort of tariffs around. And so we're basically going to come back to where we were, going back to April or something like that. So just help us think about this, Guy, because the market's gapped higher on this. We've had this gap to new all-time highs, 2 consecutive gaps in the S&P 500. And I mean, is this one of the things that just you kick the can down the road and that's enough?
Well, if it's just through the lens of the market, again, that's what we're tasked to do. I mean, it's a master class in terms of being able to say what the market wants to hear. You sort of lose a couple rounds to win the overall fight. And I think to a certain extent, that's what we're seeing. I don't think it's enough to answer your question specifically. There needs to be some framework, but what winds up happening is, and you've said this, the historic, 3.5%, 4% tariffs we've had sort of in aggregate across the board. I mean, those numbers are now close to 15.5% to 17%. Obviously not going to be anything close to the 100 to 150%, but still 5, 6, 7x what we've seen historically. When I say historically, over the last 10 to 20 years or so. And with an S&P at all-time highs and with the valuation now we're probably approaching 23.5 times next year's numbers. I mean, there's no way the market is pricing in that jump from 3.5, 4 to 16.5 to 18.
Yeah, and just before we get out of here on the China framework, Peter Bookvar, a good friend who writes the book report of 1 Point Financial. This is important here. Any agreement between the U.S. and China will be less of a deal than the realization that both countries really need each other with respect to trade. Getting China to buy more soybeans, or easing their delivery of rare earth magnets, or reducing the tariffs we put on them, which we mostly pay for, and providing more tech products, is all just going to back to the way things were, entering this year. If there's a lesson to learn, there's also that limiting China's access to U.S. technology has backfired. That's a debate. We also sped up their desire to be more independent of U.S. trade-wise, and thus we're losing major customers and gaining a major competitor. Again, economics will ultimately trump ideology, it seems, with any deal agreed upon, and the desire of some to decouple from China commercially is just as delusional, as we both really need each other for now.
I think that's all fair. I think both sides understand that we are codependent in some ways, and everybody's going to everybody wants to win or save face. And I think both sides can probably do that. But, we'll see what comes out of this Thursday, and if it bleeds into Friday or over the weekend in terms of a meeting. This could also be one of those classic, the two men sit down, they hammer something out. You see the great photo op, and then maybe that's the crescendo that the market has been looking for. Maybe that's sort of that final gasp to the upside. We'll see. What's amazing to me, though, is the market has completely, with the exception of a day here and there, the market has looked past the strong rhetoric and has basically been rallying seemingly and building upon the same piece of news over and over again, which again, I think is somewhat unhealthy.
Yeah, so once we move away from China, then we focus on mega cap tech. Obviously, all these names, at least the top 5, are reporting this week. And so, like as Peter said in this note, that, obviously, tech products, whether they be, NVIDIA's GPUs and a whole host of other things, are very important for China to have access. Peter's point is that if we limit that access, then the Chinese companies are going to be, that much more incentivized to innovate. We know that Huawei has had some good results on some high-end GPUs, and the Chinese during this trade spat have encouraged their tech companies to buy locally, basically from Huawei, and not, participate in the purchase of, NVIDIA and that. So that's really interesting. Just one thing on the tech stuff, Guy. We have Amazon, we have Meta, we have Google, we have what else? Microsoft, and we have Apple, all reporting this week. And before we get to Carter for a second, it's like, we always put this emphasis on these big names here. And then the idea is that here's like, 12, $13 trillion of market cap, that they're all going to go the same way. You know what I mean? And that's not normally how it happens. But, one of the things I think you and I are both focused on is like, what are the main themes that these stocks have accrued all this market cap gains and been powering, I think, 80% of the gains in the S&P 500 this year. And if there's any stress on those themes, it doesn't have to be that the companies are, downgrading guidance or missing here or there, that sort of thing. But if the themes start to weaken, then it causes investors to start to think, okay, should I be peeling out of this? Because the market's performance, for the most part, for 3 years has been this theme.
Yeah, that's fair. And, to your point, I think we look at it as sort of, you lump them all together thinking that it's be all very good or all very bad. And historically what's happened is some are good, some are bad, some are middle of the road, and they sort of even each other out. But in terms of just the importance of the marketplace, you just said it. I mean, probably the names that you just mentioned, probably closer to $14.5–15 trillion of market cap. Not that, I'm splitting hairs here, but you can't underestimate the importance and what it means to the broader market. I'll say this as well, and this was a note from Torsten Slok a couple of weeks ago. The passive investing is obviously here to stay, number one, but the companies that you just rattled off all win to passive investing because of the amount of ETFs and mutual funds that they find themselves in. So in the absence of anything negative, I mean, these stocks just win if they do nothing for the remainder of their lives.
Yep, no doubt. All right, let's do it. It's time, Guy. Carter Braxton Worth of Worth Charting. Carter,
He looks like
how are you?
Oh, look at that. He's all
What's going on?
Dude, you
headed out to a lunch. Yeah.
You are not messing around this week with. Let's throw up that earnings slide here, because there's a lot of great stuff going on here, but we're focused, or at least you are focused, on the big 5 this morning on Worth Charting. It's an epic report, Carter. You lay out what the implied moves are. You take a look at all the charts. When you go into a week like this, Do you think this is a pivotal week for the broad market, or is it really just more focused on these individual names and really how you think about it from a mosaic standpoint? Like, how do you approach a week like this when you have such big market cap companies and then everything else?
Well, it really depends on who one is in the market, right? So if you're sitting there as a fiduciary, engaged as a professional, if you will, running money for others, it's not just about the names that are so big that drive so much, although it of course is because they're so large as a percentage of the overall equity complex, but it's the names that you've built into your portfolio and your overweights and underweights and your judgments based on, trying to put a present value and future cash flow. At the individual level, it's really even more so about that. I don't think the individual, for the most part, is sitting there thinking about, well, I need to be, cognizant of this, and this is where I could get in trouble if I have to speak to my clients and my overweighting or underweighting in tech, and how will I explain? You're just trying to speculate. Let's just call it what it is, right? I mean, that's what, to a large extent, it's all about, is trying to take a buck and turn it into 2 or 4, right? And so just because the big ones are so big, again, the 5 that report this week are 25% of the S&P weight, 15 plus trillion. We thought that the focus should be on that.
As it makes a lot of sense. And I think this is an historic amount of charts that you brought forth. So there's our calendar. Let's look at your first slide and then walk us through. I think we're starting with Apple, but the first slide sort of illustrates what your, historic implied moves over the last 4 quarters and the implied move post earnings for this quarter. So walk us through.
Perfect. I mean, so, we thought we'd just put the facts and figures out for all to see, which is, these are the implied moves, which the option market is giving you that implied move, and then the implied move versus how the stocks individually have moved over the last 10 years, so 40 quarters. And you'll see that, the lowest beta one and with the least implied move is Apple, and then, the more speculative, if you will, Amazon or Meta. The other two, Microsoft, one could say, is utility, right? You have to use their product, and Google, to some extent, you have to Google things, whereas Amazon is got competition, so to speak, Meta and so forth. So there you have the implied moves, there are the average moves. And I think we've got other slides about just, here.
Well, hold on 1 sec, Carter. I think this is important. You did have some other slides with a bunch of data, but I just think for the here and now, I think taking a look at the implied moves the one day after these companies report, pretty interesting. And I think that you illustrate the fact by going back and looking at the last 40 that they're fairly, consistent. The more speculative ones have always had higher implied moves. And I just want to kind of touch on one thing here. So if they're 25% of the S&P 500, I think these stocks are about 35, maybe even 40% of the NASDAQ 100, right? So when you think about that, so those are one day implied moves. I want to look at the QQQ for a second here. And Amanda made a nice little chart that I think Guy is going to appreciate here. The back of the envelope way to figure out what the implied movement is in a security. So looking at the QQQ, let's say it's trading around $625. If I look at the weekly straddle, that's the call premium plus the put premium at the money, right? That expires at Friday's close, right? That would cost me $11. Again, I'm taking the October 31st 625 call and then the 625 put. I put that premium together. I get $11. I divide $11 by the strike 625, and I basically get the implied move up to 636. Okay, or down to 614. So 2.5% basically in either direction. And you just saw all those implied moves of the individual names, which for the most part are all above 3.5%, many above 4%, some as high as 6%. So the index or the ETF that tracks the index is generally going to have far lower implied movement because it doesn't have the idiosyncratic movement of each individual name. So I just wanted to kind of walk through that because I think that's important to kind of frame how the market, or at least market makers, are thinking about the potential movement overall. Normally, in any week that doesn't have all these earnings, you're going to see the implied movement in the NASDAQ 100 about 1.25% or 1.5%. So I just wanted to highlight that, Carter.
Yeah, I mean, this is obviously speaks to how big a week it is, for better or for worse. And so what's interesting also is terms of, just valuation for what it's worth, the two riskiest ones are the two that have performed so poorly, Meta and Amazon, both below their tariff high of February. Imagine that, where the S&P is way above. Apple's trading at almost twice the price to cash flow as Meta and Amazon, which, to some extent, one would argue based on their cash and their safety, so to speak, that they are deserving of that premium, even though one could debate whether they have any earnings growth. Anyway, so I don't know what charts or slides we have, but here, this is a two-panel depicting stock, Apple, and then on the bottom it's relative performance. So I've written there the good news and the bad news you see on the upper left. Well, the good news is it's been one of the best performers since August of these stocks. You can see that relative performance line on the bottom panel. The bad news, of course, Apple's relative performance the past 3 years, the duration of this chart is terrible. My hunch is it breaks out.
Breaks out to the upside.
Yep.
Let's take a look at the next one. And there's obviously that depicting it. So let's walk through, because you brought all the big ones with you, and you did obviously some pretty interesting work here.
Yeah, well, thank you. I mean, I thought that we would do it visually as well. So we have the table. This is the implied move by the options market, as Dan just sort of explained. And so which way? One could say, well, that doesn't help us at all. So you have to make a judgment or not. The next chart puts those two. So the implied move suggests 271.80. If it's up, 253.86. Now, it doesn't have to move that amount. I've drawn the green arrow. My hunch is that this is good for a breakout. That's a judgment, of course, our hunch.
Yeah,
we can go through. Yeah, go ahead.
Yeah, and what's interesting, Carter, and I know you don't really care that much about the fundamentals when you're doing this sort of work. And, I always have a hard time as far as narratives like into prints, right? And when you have a stock that has rallied into it, and, one of the things, like, for instance, if it's because the iPhone sales are better than expected, well, what just happened is not going to be incorporated in the quarter that just gave, but they're going to guide, right? And so, I always get a little nervous if a lot of the news is in the stock into the print, but I see what you see here, and some might look the other way and just say, yeah, it looks like a double top, and I think a lot of news is in the stock. But again, that's what makes a market, Carter.
That's what makes a market. And again, what appeals to me is impressive relative performance to the S&P, to other big tech names over the past 3-4 months since that August low. I don't know which others we have.
We have Microsoft.
Let's go. Yeah, Microsoft. So here I've written the good news. Look at Microsoft. We know it gapped up the prior quarter, gapped up again this most recent quarter, but faded, closed very poorly on the day. So look at that poor relative performance line, relative strength line on the bottom panel. That being said, it's down to the penny, to the 150-day moving average, and that's where you can often get a bounce. But in terms of the absolute chart, here's the same setup. You have 4.43, and it doesn't have to move the implied move. Sometimes there are a lot more. Look what happened to Google last time, or Oracle, right? And so that's the level, and the final is our judgment. My hunch is up.
Yeah, I mean, Guy, thoughts here on the Microsoft. We've been highlighting the fact that the underperformance relative to many of its, mega cap peers over the last few months since its report. The line that you drew the downtrend there, Carter. I mean, that comes from the all-time high, a massive gap. It was 8%, after its last earnings. The high tick was the opening tick. The low tick was the close, and then you saw it continue to go lower, and then it's just been banging around. Guy, like this one, do you see it that way? I mean, to me, if this is a second consecutive quarter where the news is in the stock, I have a hard time thinking we get back to those prior highs. But again, I have no idea what they're going to suggest.
Obviously Carter's looking at through the lens of technicals, which is his want to do, and he's great at it. If you look at it just through the lens of fundamentals, I mean, they have to say some pretty remarkable things, in my opinion, at this valuation to sort of approach the levels that we saw the last quarter, which was, again, if you think about the underperformance of Microsoft from July of last year until obviously earlier this spring, it was noteworthy. So stock has gotten itself pretty expensive. I think it's trading close to 33 times next year's numbers. I'm hard pressed to imagine what they're going to say, but you see, we're going to talk about Qualcomm probably in a minute, but you see some of these headlines and you see some of the moves on stocks that are pretty large market cap names. It's not out of the realm of possibility, especially given what the market's been doing, to see this thing push up to those levels we last saw last quarter.
Yeah, and again, this one I guess is more controversial to me than some of the others. And one of the ones that was a huge lagger is the Alphabet. Related to many of the other mega cap tech peers that were right out of the gate in 2023, like Microsoft and Nvidia, and Amazon and Google had lagged. So Alphabet is obviously caught up here, and there's a lot of narratives that I think are tailwinds to them, Carter. But the chart looks very different than some of the others because it broke out on a big gap and is kind of consolidated or continue to move higher. So this one is really attractive to me.
Yeah, I mean, there's the implied move. Take you right to the top of the channel, take you right to the bottom. Those are the levels. I put the green arrow in. I think you get another gap. It's just a real laggard that's playing catch up even still.
See, this is the one that I look at and say, yeah, there's a real opportunity for this thing to get on its horse and to push and to stay in this channel we've been in since the spring and to go to the upper band, which probably takes us closer to 290-ish or so in Google. So I'm in absolute accord here, Dan.
Yeah, and again, the narrative was so bad for like 2 years, despite the fact that this company was meant to be well situated, given all their investments that were leading up to the release of ChatGPT and their competitive positioning. But they also, were in a position where a lot of folks thought that they were one of the companies to be most disrupted. And I think that, some of the things that they've been able, like products that they've been able to ship, and some of the, the quality of their ability to move away from that core search business is something that investors clearly believe in. So I'm with Carter on this one. If they are able to demonstrate that they are not cannibalizing themselves, but they're basically, opening the door to a new kind of era of search, I think that's probably one of the big stories going forward. Now, Amazon, Carter, on the flip side, is one of those ones that I think I'm fairly well convinced that they are being disrupted. That ad business that they have that's been such high margin, I think these GPTs are really going to make a dent on them. And the other thing is, AWS, which was the cash cow for this business, has really slowed down dramatically. They've lost market share here. And I think this is one of the main reasons why this stock has lagged its peers, but also the broad market.
Yeah, so look at that relative performance down the past 3 months, down year to date, still below its February pre-tariff sell-off high. I mean, that is the definition of non-participation, or what they would call no alpha. In terms of the chart, there's the implied move. That levels would be 237, 210, and then I put the red arrow.
Red arrow suggests lower. I mean, you could look at this across those tops, Dan, and say short-term double top and this support level, which we've tried, once or twice over the last couple months, at some point gets broached. So this is a hard one for me here because I just see the way this market is trading, but those double tops, Dan, stick out to me for sure.
Yeah, and the other thing, what I think this is like, what this is illustrating, and I think Meta that you're going to go to after this is just really important because we're starting to get to a point where it's just not rising tides lifting all boats, right? And we just hear every day there's like 10 different articles from major publications debating whether AI is a bubble, and some stocks continue to act that way, like it feels bubblicious. Like today is a great example. Nvidia, okay, is up, as I'm looking at it, 2.5%. It's making new all-time highs on a day that Qualcomm is trading up 12.5%. It was up more than that because they just announced a chip that's competitive to that of Nvidia. So you think if investors are like taking Qualcomm up like that, right? You think that Nvidia, who they're meant to take share from, right, would be down on the day. And it's not. And that sort of enthusiasm is a sort of thing that causes people to think about a bubble. But there are some companies, there are some stocks that are not benefiting in this bubble sort of environment. So I think Amazon highlights that. And then let's take a look at Meta, because this is one of the ones that's been a huge beneficiary of the technology, using it within the company, but also the way they target ads, and that's adding value for their customers.
And Meta, not quite as poor a relative performer as Amazon, but still relative strength is deteriorating. And let's look at the absolute chart. Again, quite a similar setup as is the case with so many of these, meaning it's decision time. That's the level. And then I've given this the push. I think it's going to maybe, to a whole lot of nothing.
I look at, it's funny, Dan, before we let Carter go, you think about what you just said in terms of NVIDIA, and you're right. But, you think then what we talked about with the passive investing thing, you look at the SMH and you look at sort of the different ETFs that have all these semiconductors in. A name like Qualcomm having a move like it's having today, it's just going to drag the SMH or the stocks up, which then subsequently drags up all the names that comprise the ETF. So it becomes we talk about this circular thing and how passive investing can drive. I mean, that's a great example of this, I think.
Yeah. So Carter, just again, real quickly, I know you got to go. I mean, when you see a move like this, and there is no way, it's not like the company came out and said, this is the TAM and this is what we expect to take as far as market share. And this, like, investors just piled in on this thing. It's up, 16% at its highs. Now it's up 12.5% or so, or maybe it's actually given back some of that. Let's do a one-day chart really quickly here. What do you do with a name like this that's been a huge laggard, and it just seems like this is a little bit overdone? You probably stay away here.
Yeah, I mean, think about the volume already. It's only 11. It's still in the forenoon here, and it's a 50 million shares have changed hands. The second data point that's important is not only the epic volume, it'll be a record value traded today, but look where it is in relation to its range on the day. It's already given half of the move back, meaning there's no follow through. That's exhaustion. So what's remarkable in an instance like this, if you just do back to the 6 month chart, we can look at today's bar. There are people who have an epic gain today, and there are people who are literally puking on their shoes, puking on the desk. They bought it at 200, thinking it was going to, and now they're staring at 190 or 210, like, oh my God, what did I do? So we've all been there, and there's no answer to it. It's why this is called risk assets. It's not gym work or librarian work. All the honor to the gym teachers and librarians. But the point is, this is dangerous stuff every day, every minute. But my hunch is this will continue to fade, and is a sort of a whole lot of a tempest in a teapot.
Oh, I like that. A tempest in a teapot. Well, Carter, this was extraordinary work. Those are a lot of charts, a lot of work behind them. And obviously, with the week of earnings that we have, it's great to have it on a Monday ahead of these things. So as always, Dan, Nathan, I want to thank the great Carter Braxton Worth. And, Carter brought these charts and you want to trade around them. But when I'm trading, Dan, I want real-time data, customized alerts, and powerful tools that can help me act quickly. But most importantly, I need an easy way to access those insights wherever I am. Fidelity's Trader Plus platform, you can stay closer to the trade with seamless access to your preferred tools and charts across the desktop, web, and mobile. When timing is everything, this week speaks to it. You need a platform that can meet you where you are, Dan, Nathan.
Well, that's also important, because over the last 5 years, I think lots of traders, lots of investors, they're not sitting in their seat all day long, right? And I think some of the advancements they've made on that desktop product and how seamlessly it works with the mobile products, I think is really important, because the experience that you're having as you're moving around on mobile is very similar to that on the desktop. So we appreciate Fidelity being a great partner of ours, Guy Adami.
It's very exciting. And, when Carter brings those charts and you look at it, I mean, again, he's talking about his observations and where he thinks you're going. But the beauty of trading is you can look at those same charts and come up with a completely different observation or a completely different trading strategy.
Yeah, sons of bankers, sons of lawyers. When he started talking about librarians, and that was pretty. He is a store of market knowledge going back.
Elton John. I know that was nicely done.
Saw what I did there. But didn't you start feeling that a little bit when he said the librarians and this and that, or whatever? And he said, all due respect to them. I've been reading really quickly. I'm almost done with Andrew Ross Sorkin's 1929. And it just came out a week or two ago. This book is fascinating. And I encourage any folks that are just, steeped in market history and are just immersed in the market right now. I don't know if your history goes all the way back to nearly 100 years, but this book, and you read Reminiscence of a Stock Opera, and he talks a lot about some of the characters, and one of the main characters, obviously, that was in that book. But when you read these and you're like, holy shit, is this right now? Like, is this what's going on right now in the market. And so it's just fascinating to me. And that's why I love hearing from Carter. I know that he started in the late 80s. You started in the late 80s. I started in the late 90s. But a lot of the 87 crash, you were there for it. You were there for the dot-com. You were there for the financial crisis. You were there for COVID. And a lot of things that went on the way down and then on the way up, they're just really similar.
Well, I haven't read the book yet. I've read excerpts of the book and I've seen Andrew's interviews. And I think what sticks out to him as he was writing the book, to your point, are some of the parallels that he saw from that period of time to what he's seeing now. And he's careful not to sort of make a complete correlation, but he points out that, history is absolutely rhyming in terms of the work that he did. By the way, it took him 8 years to research and write this book. So it's not like he just woke up one day and decided to put pen to paper. I mean, he did extraordinary research. He told us the amount of research and the amount of archival work that he needed to do. So it's definitely worth reading. Again, we're not suggesting that history is going to repeat, but it certainly looks a lot like it did 100 or so years ago.
Guy, the characters, it looks like it's written like a novel. And I hope this thing is going to be like a 10-part Netflix series or something like that, because it'll be utterly fascinating, amazing characters, the intertwining of that with politics and policy and all that sort of stuff, not too different than what's going on right here. Okay, so let's just kind of put a bow on this. We have the S&P guy up 1%, gapped up there, new all-time high. Same thing for the NASDAQ. It's up 1.5%. Obviously, the biggest names are acting the best in the market, but we're also seeing a lot of areas of the market kind of come in a little bit. Some of the retailers not acting particularly well. Some of the money center banks kind of underperforming a little bit. You know the names: JP, Bank of America, Wells. And then I'm just kind of looking around. There's some tech stocks that have kind of given some of it back. I'm looking at some of the storage names. Thoughts here about how you think we close after a huge gap like this to all-time highs?
Well, I mean, there's obviously excitement going into this meeting on Thursday. The VIX at 16, sort of just basically back to where it was a few weeks or so ago. I mean, it's the outperformance in the NASDAQ that sticks out to the names that you just mentioned. Obviously, Qualcomm sort of sticking out like a sore thumb today. I mean, how do I think we close? It's hard for me to say, that we're going to do anything but continue to sort of flatline where we are today. I'm hard pressed to see us trade significantly higher from these levels or significantly lower. This feels like one of those days where you open just around the same levels where you close, and then let's see what happens tomorrow.
Yeah, just before we get out of here, one of the names I'm really focused on, and it's not because I think it's such an important name in the market or in tech or anything. Pull up Netflix for a second here. So this is a stock that I think if Carter was doing his charts like he just did on the 5 big ones, he would have said the relative underperformance to its peers, to the market, was something notable going into the print. The print was slightly disappointing, at least the guidance here. You see that 200-day moving average that was rising. We highlighted this last week that even in April during the downdraft, this stock never broke its 200-day moving average. Go back 5 years. I mean, it held it like a what, guy?
Like a boss.
Like a boss. And here we are now. This thing doesn't have support. I think you got to go back to that high from February, guy, which
like
was the all-time high.
I think. Yeah.
Yeah. And so what do you do? I mean, like, it has not seen an uptick since it reported. And a lot of folks didn't think the quarter was that bad or the guidance was that bad.
No, and it's all the way. It's not necessarily the quarter. It's the reaction to it. You say it all the time. And, I'll go back to, before we get out of here, it was June of this year when Tom Rogers, who had been a staunch bull in Netflix for years, he actually sort of pivoted a little bit and said, he was seeing some things around the edges that concerned him in terms of the stock. And that was when the stock was trading, I think, 1340-ish. And now look at what the broader market has done, and then look at the reaction that Netflix has had since. And I think your level is exactly right. Get to 1050, that prior all-time high from February, then let's see what happens if and when.
Yeah. And one last thing. All right, pull up SanDisk, because this is a stock that's been an absolute monster. Okay, so this is a storage company. It goes into the servers that train the models that go into the data centers. The whole drill. And this has become, guy, just in the last 2 months, an absolute darling. I mean, look at this. You could have had all the stock you wanted at $40 all year long. Okay, so here we are at 182. I just want to highlight the fact that you see this thing gap to a new all-time high. Put a 3-day chart up there, or 5-day, or whatever you want to do here. So after Friday's gap to a new high this morning, the opening tick was the high. Is it going to fill in that second gap, right? Going down there. And so these are the sorts of moves that I'm really focused on, because I think that some of the stuff that's way overextended, that looks like on an RSI, like it could go no higher. Maybe that's the thing, So I think you keep a lot of eyes or you keep eyes on a lot of these semis, because I think they're going to tell you the way they go is the way of the market.
100%. Obviously, great thanks to the Carter Braxton Worth. We will be back tomorrow on Market Call, 11 a.m. We got a big week here at Risk Reversal Media. I think, if I'm not mistaken, correct me if I'm wrong, is Mike Wilson joining us this week on the podcast?
Mike Wilson, Morgan Stanley, is joining us the day that the Fed is coming out with their rate decision. Fed funds futures, the CME Fed tracker, is implying basically a near certainty of a 25 basis point cut. He's going to be sitting with us as this press conference goes on by Fed Chair Powell. So we're going to have that drop in the feed Thursday morning, first thing. Check it out. We're going to have a lot of good stuff here on the Market Call. Liz Young's going to be with us. You know the jam. So thanks a lot.
Thomas.
Liz Young Thomas. Let's split the difference here. Thanks so much, everyone, for being here. We'll see you tomorrow.
This episode of Market Call is presented by Fidelity Investments and their all-new advanced trading platform, Fidelity Trader Plus. Try it at fidelity.com/Trader Plus. Fidelity Investments and Market Call are not affiliated. Views, opinions, products, services, and strategies discussed are not endorsed or promoted by Fidelity Investments. Fidelity Brokerage Services, LLC, member NYSE, SIPC.